I think it's great.
And just to have fun with the entire community here at the Business School, everybody is welcome to talk about the always fascinating comings and goings of markets everywhere. Let's get into our program today. One of the ideas of this podcast is not only to interview great investors, but also great investors who should be better known by the investing community because of their record. The record of our guests today is simply a thing of wonder, their insights or the uniqueness of their portfolios. And we're happy to bring one such investor today to the Investing with Age podcast. Our guest today is Amit Wadhwani, the founding manager of Moeros Worldwide Value Fund, which was launched in 2015. Moeros' 5 years record is on the north of an annualized 23%, beating the index by more than 10 percentage points. So it's really a remarkable performance over the last 5 years. Prior to co-founding Moeros, Mr. Wadhwani was a portfolio manager and partner at Third Avenue Management, working with someone who is a great value investing, or was a great value investing lane, Marty Whitman. He was there, I believe, that he met many of his co-workers now at Moeros. He has an MBA from the University of Chicago, my alma mater, and a BA with honors and an MA in economics from Concordia University. Taught economic classes there, I believe, so a fellow professor, always good, and holds a BS degree in chemical engineering and mathematics from the University of Minnesota, so a very interesting academic background. Looking forward to getting to know that. Amit Wadhwani, welcome to the Investing with Age podcast.
Thank you. Thanks for having me.
We always start with some biographical details of our guests to get to know them a little bit better. So tell us a little bit about where you grew up, and was there any inkling about your future in investing in your youth?
I grew up in Bombay, India, known to most people these days as Mumbai. My exposure to finance at the time was de minimis, non-existent really. I mean, sensing that I had sort of an aptitude for things quantitative, I was pointed in the direction of science stream in high school. So nothing could have been further from my mind than the finance or matters of commerce. This is a complete terra incognita for me. At the time, anyway.
Can you tell us a little bit about how you get to Concordia? How was your path then?
I started at the University of Minnesota intent to get a degree in chemical engineering. I found way less than engaged in. Mathematics, on the other hand, was great fun. So I did a second degree in mathematics. That sort of kept me sane. I was already there, so why not? At that time, a career in pure sciences was probably in the cards, probably. But nothing so far pointed out in the direction in finance. Now, the first baby steps towards finance took place when I moved to Montreal to finish up in Minnesota. My day job, I had evenings off. It's just ridiculous to have something that's circumscribed by a 9-to-5 kind of schedule, but it happened at that time in my life, which is a great thing.
What was your day job at that time?
As a chemical engineer, I was writing patent applications for a research center. It's highly unstressful. It's very, I'm not saying predictable, but it's generally circumscribed in terms of its time demands. So you had lots of time. I mean, there was a year I studied some Japanese, which was fun. And then I just happened to take a course in economics. And it suddenly was my first course, and I fell in love with it. I said, my God, this is good stuff. But 3 years later, I graduated with a bachelor's degree and a master's degree in economics. I think I was lucky. I was working full-time and doing this in evenings. It was great fun. I quite enjoyed it. These quantitative sort of things, there's lots of econometrics, lots of mathematics, and that was the sort of way I was going. Now starts this succession of random events. While I was there, I suppose I was keen on this subject. So there was a publication, which I'm sure you all know about, the Journal of Economic Literature, which summarizes recent developments in economics. But therein, I read an article, a book review. It was a review for a book written by a famous mathematical economist and game theorist called Martin Shubik at Yale. And so Martin Shubik said, I certainly know Martin Shubik, and I thought he wrote a book about investing. That should be interesting. It had just been published in 1979. I took it out of the library, and I thought, this is a strange book. The book is totally user-unfriendly. The prose is totally unfriendly. And I was not just a bit fascinated by the book. Now, the problem with the book was it presupposed you knew a bunch about accounting and finance. I knew neither of the two things. So it was a bit mysterious, but nonetheless, it was a pretty engaging book. As it turned out, the co-author of the book was none other than Marty Whitman, a person I knew nothing about. I wouldn't have known Martin Shubik I knew something about. Marty Whitman I did not know anything about. Since I lacked a rudimentary understanding of accounting or finance, I mean, there's a lot that I glossed over, a lot that made no sense to me.
Because both of them were here, if I'm not mistaken. Martin Shubik was at Yale Econ Department for Marty Whitman was at the School of Management.
Correct. Marty was a professor. He taught at Yale for a number of years. Martin Shubik's name was known to me. As I mentioned, I had sort of a vaguely quantitative bent, which I will not admit to anybody at this point in my life. I knew about it. That's what caused me to read the book. Enjoyed it, but I wasn't sure I really quite grasped it, but it was very, very engaging. After the master's in economics, I said, what do we do next for fun? I want lots more economics. I wasn't sure I wanted to become a PhD in economics and become a professor in economics. I had seen academics is great as long as you wind up in the right place doing the right thing.
You can be honest a bit with us.
Oh, no. So I said, why not? Why not do something sort of hybrid? Take a course, a master's, an MBA, for example, which is very, very heavy with economics. I thought of two schools, two some different schools in terms of doctrine, MIT and Chicago. And formed phobic, so I applied to one. I got it. Now, that was Chicago. Then followed what was, I think, kind of an influential part of how I learned to think about what I like and what I don't like. Was how do you fund this? Because they had scholarships and I wasn't getting one. I was working in Canada, getting Canadian salaries as an engineer, paying Canadian taxes at Canadian exchange rate. And that is a nightmare of nightmares. I want to go to Chicago, but I can't afford it. Well, so the first thing is how do you A, reduce costs and B, realize assets? The one thing I did figure out that one could do with a bit of maneuvering is you could squeeze the program into roughly 1 year. It's doable, but very painful, as I found out. But it's doable. So that's part of it. So that reduces one set of fixed costs, living expenses, and so forth. Those are time dependent. The second, of course, you can't change is tuition. Now, the tuition, of course, is an invariant. You have to sort of start figuring out how you fund that. And funding for Canadian study for masters in the United States was very limited. Just for context, this is taking place in 1980. 1980 was a period of very high interest rates. It was also a period when Quebec, where I lived, Montreal, had its referendum. Assets were being sold willy-nilly. Real estate was being sold. It was absolutely crazy. I said, well, I'm going to live here. Buying an apartment or house cheaply is an excellent thing. So I bought a slice of a multi-unit dwelling with this idea of living in it. And then I get in Chicago, and they said, well, what do I have that's not nailed down that I can sell? Now, this time we're post-referendum, get in Chicago now, it's 1981, and of course, the environment has changed. Amazingly enough, I was able to sell that place for probably about 120% more than I paid a year and a half earlier, and that paid for one of my years of my tuition. This would be an interesting way to make a living. There are times of distress when people are losing their marbles. If you don't lose yours and can calmly buy something, and that, of course, points to my views of debt aversion, leverage aversion. You can't have a margin call at this moment. So you buy and you sit, and you can do quite well. There was a part of the learning. One was reading this book with Martin Shubik and Marty Whitman, which talked about how they invested. The other was actual real-time experience. I go to Chicago, I have my good hefty dose of economics, finance, and accounting. I return. Now I said, well, this education is quite the opposite of what I read in the book. You return to the book with some knowledge. Hopefully you understand it better what you're reading when you read it. It still was a very unusual book. It was a very, very unusual book. It was written from a very different perspective, and so on and so forth. So that was my introduction to Marty Whitman originally. Separately, now we are now talking 82, 83, 84. I get to know the firm MJ Whitman, the predecessor to Third Avenue. It was a broker-dealer. I got to know them. I was not quite in the world of finance yet, other than being their client. I wound up working at a sell-side firm in Montreal as an analyst, focusing on paper forward swap securities. 2 years into that, I inquired if there was some interest in doing something with me, for me, I could do something at MJ Whitman. And they said, sure. So I joined MJ Whitman in July 1990, ironically Canada Day. That was my starting point in my education, so to speak.
You arrived and started working before it became Third Avenue?
Correct. It initially was just MJ Whitman. They were managing what was called Equity Strategies Fund, which was subsequently liquidated. Equity Strategies Fund was a closed-end fund that he took over the management contract, hostile takeover, and open-ended it. It became an investment vehicle. The only problem with the investment vehicle was they made an investment in a company called Anglo Energy, which later turned to Naylors, which is an outrageously successful investment. And Marty said, I don't think I should sell it, and I will not sell it. And of course, in the process, he blew through all the diversification requirements of the 40 Act. It ceased to function as a mutual fund. It was late in 1990, which was the first year I started there, started in July. In late October, early November, they started the Third Avenue Value Fund, which was run by Marty. That was the flagship fund of the firm for a number of years.
If I can dwell a little bit on Marty Whitman, because he's one of the giants in the value investing community. I got to know him once when I was being trained to take over the center. Bruce took me to meet some investors, of whom one was Marty Whitman. It must have been 2008, 2009. I remember that conversation very well because the man left an impression on you. The raw you there was quite evident. But I want to ask you something about his biography as an investor, if I may, given that you had a front row seat there. He started as a distressed bankruptcy investor, and then he made the transition as an equity investor. I don't know if you know this, Amit, but one of the first things I did when I took over the center is to add a credit track to the program on value investing. And it's kind of like the Marty Whitman career in reverse. And I wanted to ask you about that transition in Marty Whitman's style of investing. You go from thinking about, I can see the connection with you, this emphasis on assets, this emphasis on downward protection. But how is that transition for Marty Whitman from being bankruptcy to being an equity investor?
Just a nuance here. Bankruptcy investing is a much more high-profile thing. There's lots of posturing, baring of teeth, threatening each other that goes on. It's a very public, noisy kind of thing. A bit of like a zero-sum game that a president plays. But seriously, though, Marty always invested in equities. There's no question. For example, I mentioned Anglo Energy, which is an incredible investment. The company was a land driller, which blew up in '85, was recapitalized twice through two bankruptcies, and emerged with a completely debt-free balance sheet and with equity. The equity was created at a very, very, very low price, probably at 50 cents on the dollar. This thing went over 60, 70, whatever, price, dollars, a number of years later. But he was a great debt investor. I was known for that because that's a much more high-profile activity. It's much higher profile. But there was always equity investing along the way. Equity investing, I mean, even in the 70s and 80s, apparently, the firm Manchester Whitman was running those years, they'd be buying things like Tokyo Marine and Fire in those days because it's an ADR over here, and it's also this company was also very cheap. Equity investing has always been a part. Now, the connection between the two is sort of as follows. If you think about bankruptcy investing, and this is my sort of very naive, very high-level take on it, is what you have is a business, on one hand, the left-hand side, it's probably a functional business of some sort. Hopefully it is good to decent and average business. It's the right-hand side which needs work. The right-hand side is often highly leveraged. There's different categories. There's a whole pecking order. There's the seniority all the way down to the bottom. The bottom is this poor little thing called equity, which is, of course, vulnerable to everything else that goes above it. You obviously have to pick the correct fulcrum security to be able to garner a serious payoff in a bankruptcy reorganization. If you think in those terms, you're buying as an equity investor, which he was a good part of the time, buying the junior most security. Hence, there was, I don't want to use the word persistent paranoia, but there's the fear, the concern that you would be steamrolled by the people above you. It's more than just that, and be it more sort of worry about more than just the capital structure. There's a whole bunch of business-related things that concern us typically when we buy things. His mindset, he called it the primacy of the balance sheet when he talked about equities, as opposed to thinking about earnings. That is something that we have, I don't want to use the word refined because I think that'd be self-adulatory. We think of it as our asset-based approach to investing. You think about assets and you think about the capital structure of the business. Marty spent a lot of time on the right-hand side. We spent time on actually both sides. Being mindful, this is something I learned from dire experience, by observation and experience, I suppose, is balance sheets morph over time. The same balance sheet, a snapshot at one point in time and a different point in time. In one point in time, it's a thriving company. Another point in time, it is a company that has an unfeasible balance sheet, something that's not workable.
Can you just tell us a little bit more about your career at Third Avenue? And in particular, we're curious about the expansion into international markets. You were responsible for founding Global Value, Emerging Markets, International Value Funds. Tell us a little bit about that process and evolution.
Nothing is linear in my past. One was I owned MJ Whitman. That was in 1990. That was in July 1990. In October, late October, early November, the Third Avenue Value Fund was founded. This fund was run by Marty, and uniquely by Marty. I was an analyst on the sidelines. But the one thing that was obvious to me was that what we did in this fund could be pursued outside the United States. Now, Marty was a very US-centric fund. All of us come with our personal baggage, our personal experiences, our knowledge, and so on and so forth. The fund was very US-focused, US-centric. I wonder, wouldn't it be great to do this outside the United States, where there is a lot less competition? Most people do not think quite so much in terms of balance sheets. People tend to think much more in terms of earnings-based valuations and so forth. So there's a big, large, gaping, yawning, open opportunity for us. And I've taken this to Marty on various occasions. And his comment was the same each time. Look, the SEC isn't there, I don't want to go there. Now, because everything had to be, I don't want to say litigated, but everything had to be either arbitrated or the rules and so on. It is true there's a lot of stuff that the SEC requires investors to do and companies to do. There are many measures that are protective of investors. However, I think with careful work and careful security selection and a careful analysis of the know-how, the lay of the land, and so on and so forth, one could actually do quite well. So I said, well, look, I love what I do here, but I really do need to follow my own dream here. With Marty's blessing, I left Third Avenue, MG with at the time. And I wound up at a firm called Karl Marx. It's CARLMARKS, not the literary giants that we know. Karl Marx knew Marty very well. In fact, Marty used to manage one of the funds for the Marx family. The Karl Marx's history was similar to Arnold and Blythe Schroeder, who I'm sure you'll know about very well. So Arnold and Blythe Schroeder were market makers originally of non-US securities, as was Karl Marx. Karl Marx sold the market-making business to Smith Newcourt, which was then taken over by Merrill Lynch. It turned into basically a family office, and they had some pools of capital they managed, both family and outsiders. They had a distressed debt special situations fund, which Marty was for a number of years co-manager of. So they knew me at MJ Whitman. As a director of research, I collaborated with them on projects, and they said, why don't you start a fund investing outside the United States here? So I did. It started September 1996. It was a small fund, and it stayed a small fund, which, being a scale business, it was not too late. They said, well, I think you should probably wind it up. And I wound up taking it with me, returning to now what was Third Avenue. Myself, a little fund in tow, which is then called Karl Marx Global Value Fund. We returned to Third Avenue with a number of limited partners, most of whom notably were actually people in the industry, people who were investors, professional investors themselves. So I mean, this is ridiculous. You're one down here and you're a small fund. Over time, you will grow and we'll come with you. And so they did. That was my return to Third Avenue. I returned both as a manager of this, as well as working as an analyst for a number of the other investments that Marty had. For example, I mean, there are areas that people perhaps weren't so keen on working on. Insurance. I mean, insurance is something I've always enjoyed. In fact, one of the first things I worked on when I joined Marty, he thrust me into the world of life insurance. There was a big meltdown going on at the time in 1990. Drexel was blowing up, and that's where the opportunity lay. So that's where I said, you will work with all these insurance companies. There was a number of things I could contribute to. So in 2001, we completed 5 years for this fund, which is now called Third Avenue Global Value Fund LP. And they said, gosh, you can do it. So why don't we have a mutual fund? That's how the Third Avenue International Value Fund was spawned. The business sort of flourished after that over the years. I mean, we did what we did. It seemed to work. We had a reasonable record. People seemed to like it. And the funds grew. We were the largest and the management of institutional funds within the Third Avenue at the time when I left.
It's a fascinating story, and I didn't know that episode in your biography, the Karl Marx Advisory, going back to Third Avenue and bringing some expertise too, probably with that team that you brought to Third Avenue, which is one of the questions that I had for you. There's always a difficult question that Michael and I always ask to our guests when they leave the firm where they grew. Why did you leave? And we don't want like a complicated story. You know, what is that you felt you needed to accomplish on your own? What were the things that you thought you could not accomplish inside Third Avenue that led to the founding of Moelis?
As I mentioned, I was in Third Avenue's predecessor in 2 stints. The first one was 1994, which was for 5 years. The second one was from 1999 to 2014. In the aggregate, more than 20 years. It's a totally fair question. It's a totally reasonable question. Third Avenue, it was a great place. The first stint was wonderful. The second one was great. I was much more on the asset management side, managing investments for a variety of different portfolios. It was a dream. In the early years, it was small, collegial, very much a meritocracy, and was very focused on investment management. Success happened. With success, some things change. people want more and more. And with that, the culture morphs also. And the problem with being less of an investment focused firm, more an asset gathering firm, the culture changes. And again, we were doing many, many different things. We had debt funds, we had small debt partnerships, and there was a desire to start a very large distressed fund. There was a whole slew of efforts that went on. So we became a large, multi-headed beast. Culturally, that changed. It changed enormously. Well, there was clearly some level of unhappiness amongst the people. My team at that time, in 2013, 5 people in New York. Of the other 4, in 2013, 3 of the 4 resigned, 1 each on successive week. I was theoretically losing 3 of the 4. The quality of what you do is very much a function of the team you have, how they work together. And the thing about us was I had 2 who started in 2003 and 4, another one who started in 2007 at 3rd Avenue, and so now we're in 2013. What we did and what we do now is not sort of off-the-shelf discipline. It's not a plug-and-play kind of thing. So finding somebody, training somebody, I mean, because finding somebody is a 6-month process. Mentoring somebody will take at least a year possible. And maybe she or he may or may not succeed. We don't know. But that said, there's a tremendous risk that you take when you start off with somebody in terms of education helps, but learning by doing helps even more. There's a way we do it, the way we think about things, which tends to be a bit different. It's not conventional, it's not what one encounters. I mean, in fact, just for what it's worth, the youngest member of our team graduated from CBS, I think about a year within the last year.
Gabriel.
Yes, Gabe. The thing is, to find 3 people, at that point it was not a budget issue. It was just there was not enough time, and the risk of doing it was enormous. Either the team stayed in place, or I just moved it. The team members, one of them said, I will absolutely not work here, and the other 2 came back for a while as consultants, and we transitioned the assets to another manager. One of our colleagues was staying on, and we moved on. That was the end of 3rd Avenue. I wasn't really quite sure I wanted to do it all over again because there's investing and there's a business of investment.
Why do I
One is
speed up?
fun, the other is